Thank you very much. My name is Semi. I represent the Signal Group. For the ones that don't know, it's three entities: Signal Maritime, a shipping company that runs an Aframax pool; Signal Ocean, a technology company that I represent here today that has developed the technology product; and Signal Ventures, an investment arm that looks at investing in other startups within the shipping and commodity space. Today we will look at data primarily, and how data can be used in various aspects of the market, from geopolitical events and how those influence the market, fleet dynamics, how the fleet is changing over time, and if we're seeing an oversupply in the coming years, as well as short-term supply and demand. That's what Signal's data is quite unique. And we will close with valuations of ships and how we see them in the near future. So I'll start with geopolitical shifts, and I'll use some examples of how data can be used, since in the era we live, the last 2-3 years, there is at least 3 typically bad events per year, and the last few weeks, with Trump announcing every week something new, from Panama Canal to tariffs, there are multiple things that can impact the shipping industry. I'll focus on canals just to see how fast the market adapts in this type of changes and how this can impact trade. The graph that we see here shows how the Suez Canal's crossing, northbound, southbound, has changed the last year. You see there's a significant decrease, and this happened really fast actually. So the shipping industry has the capacity to adapt in new situation in a very fast and efficient way. And this event can happen all the time. So when Suez Canal, for example, becomes a bottleneck and vessels go through the Cape of Good Hope, the direct effect is higher ton miles, reduced supply. So while the market hasn't been amazing the previous year, the Suez Canal being a bottleneck has had a relatively positive impact, while it was a bad event, on the freight rates. And these are things that can happen typically within a few weeks, and the market adapts pretty fast. We will look at fleet dynamics, and a lot of people look at supply in terms of vessel deliveries. The main learning here is that the fleet keeps growing. The last few years there was less scraping activity, so there has been an increased age of the fleet. As you see here at the bottom, in 2024 we've reached the highest average age for the global fleet, with a constant increase that's across all vessel classes, and we will look at tankers and dry separately. So tankers, for example, 14.7, it's quite significant. That shows that for this to happen, it means that these vessels find ways to trade, due to the current situations in terms of sanctions and in terms of complexity in the market, which is not necessarily a good thing for the market overall. If we look at the projections and which vessel class will see the biggest impact, here you can see in the coming years which vessel class will see the highest number of deliveries. So 2025 and 2026, it seems like it's going to be a relatively bad year for Supramaxes, because we expect at least 151 deliveries coming. Of course, you cannot really predict how much scrapping we will see, but the deliveries, with some delays, they seem to be there. Similar situation for tankers, and both dirty and clean. It seems like the MR market will see a significant number of deliveries in 2025 and 2026. While, for example, VLCCs seem to be a little bit healthier. There were a lot of deliveries in 2022 and 2023, and 2025 seems like to be a healthier year. Looking at these numbers, I'm sure you're all looking at them, and of course brokers play a vital role in facilitating the understanding of this market. But what we see here is that the fact that the scrapping activity is so limited, because vessels of older age find their ways to trade, has a direct effect on the number of vessels overall. When we look at demand, I will look first at dry bulk and then at tankers. While it wasn't, the last couple of months has been not great for the dry market, the demand was not that bad. So when we look at Capes, and we look at Capes and VLCCs because typically they drive the global markets, since they do the longer voyages and there is a lot of FFA activity. So what we see here, that the blue line, which is 2025, it's quite similar to 2024 in terms of ton days. So it's better than 2023, but it's similar to 2024. So there was significant demand, but what has changed is that there was a lot of reduced congestion. So in the previous years, congestion was much higher at ports. Higher congestion typically means more ton days and therefore less supply. And congestion in the end of 2024 and early 2025 has been significantly lower compared to the previous years. And that had an impact on the freight market, which has been at the lowest we have seen the last year or so. When you look at, when you look at tankers, though, the demand has reduced significantly. So blue line tankers, and it's significantly lower compared to the previous year. So tankers demand is not there, and actually what has maintained the levels is primarily the ton days and the fact that lots of vessels have rerouted through the Cape of Good Hope. When we look at supply and demand, typically we try to focus on short term because that's what gives you an indication of the freight rates. And again, we will look at Capes on the dry side and then VLCCs on the tanker side. And what you see here at the bottom graph is the blue line is the ballasters to C3, which is the main driver of the Capes market, and the red line is the market. And on the right side, we have demand. And in the middle, you have supply and demand. Basically, the number of ballasters on C3 is really high, like one of the highest numbers we've seen the last 6 months. And that shows that there is a huge oversupply that it's going to be hard to overcome. Even if we expect a little bit better demand in the coming weeks, the oversupply is significant for C3, which shows that recovery is not imminent. On the other side, on VLCCs, we see the opposite effect. The blue line is the supply of vessels for TD3, so VLCCs for the Arabian Gulf, and it's actually at the lowest we've seen the last couple of months. And the market has reacted to that. And when we compare with demand, supply and demand seem to converge. So when you look at tankers, today's picture for the short term is more promising compared to the dry bulk market. Of course, that's VLCCs. It doesn't necessarily mean that this will be the same for all vessel classes, but typically, a strong V market has good impact to the freight rates. Just a small parenthesis on the India situation, and looking how geopolitical events can have a direct impact on imports and exports. This graph shows how the coal imports to India, in this case, has evolved over the last couple of years, and which is the country that is the main exporter to India. In this case, Indonesia, followed by Australia, followed by South Africa and Russia. The market is pretty stable on the coal side, and when you look on the tanker side, though, it's quite interesting. Russia represents 26% of the imports to India when we look at the last 3-4 years. That's a significant number. And now with the situation in Russia and hopefully peace discussions, that could have impact on Russian trade and imports into India, and these contracts can evolve over the years. So understanding numbers and looking how geopolitical events can have an impact on flows, supply, demand, is something we do quite a lot in Signal, and it gives you an idea of short term, how the coming week will be, how supply and demand might evolve in the next month, but also it gives you an understanding of how trading patterns can change linked to geopolitical events, changes in political situations, such as Suez Canal, Panama Canal, and things like that. The market doesn't show a significant strength when you look at the deliveries, because at the end of the day, these vessels will be delivered and will have a direct impact on the medium-term supply. Here, just an indication of Capes and later VLCC prices. We have seen an increase in prices in the last few years. So this is, for example, a 4-year-old Cape, a 2021 build, how the price has evolved based on a model, and similarly, a VLCC 2022 build, how it has evolved over time. So the interesting thing, and I'm sure lots of you are curious of how ship prices will evolve over time, is if these markets that have been very volatile the last year, with dry being at its low point, tanker had a small recovery during the last few months, will the ship prices be maintained? The logical thing would be to see an adjustment in the ship prices, especially in the dry bulk market, when you see these deliveries coming and the supply and demand not being that balanced. Of course, these are all scenarios and theories. Data can be used to have a view or to support a view at any point in time. But we're always keen and interested to understand how these changes evolve over time and what the impact will be in the next week, next month, next 6 months. So to summarize, both tankers and dry are seeing significant geopolitical shifts that would have a direct impact, similar to the Suez Canal situation. The dry market needs more demand at this time of the year, and the tankers market is maintained due to the VLCC situation, but with a lot of risks around sanctioned vessels that are coming in and out of the direct supply in the spot market. And data typically help in understanding this type of situations. Thank you, and I hope you enjoyed the numbers.